Hello everybody, Jackson here with the Wealth Squad. Today talking about 3 blue chip stocks to start averaging into. So of course this is not financial advice. I'm not telling you to. I'm simply giving you the idea to. We're going to start off with Home Depot. You can see Home Depot was once a $420 stock, now trading under 300. So the whole, builders, home builders, they've been slammed lately. Home Depot being one of the largest victims, 420 to 300, down around 29% in just under half a year, 29% down. So let's check the 5-year chart. You can see, of course, it's still relatively high, and it's still above, right after COVID. Right before was 250, so we still have $50 to go until it gets to COVID territory and takes back all its gains. Will we see that? Hopefully we could get that cheap. I kind of doubt it, but I hope so. So I'll definitely grab some up at 250-ish. Right now I'm gonna start watching it. Check out why it's getting cheap. Right? What's the problem backing this downfall of Home Depot? And they do pay a solid dividend, which we just saw, 1.9% a quarter, which they just raised that as well. So it was 1.65, then it was 1.5, 1.65, now it's 1.9, and they still kept going down. So will we see that same dividend next earnings? Probably, right? We could assume that they're not going to pay $1.90 a quarter per share. Almost $8 a share, right, per year. It's actually like 7.6, still pretty good, right? You get a 2.3% yield on a large growth stock, right? Home Depot is essentially a growth stock. It's hard to tell me with a straight face from 147 to 300 in 5 years' time is bad, right? That's a solid stock right there. So Home Depot, definitely a one to add to the list. Next, we're gonna go with Starbucks. We've talked about Starbucks on Twitter of how it's trading also at a solid discount. You can see this one's not as growing as Home Depot in the past, up only 43% in the past 5 years. And they also pay dividend, rather not big, $2 a share a year, right? So under, the yield is still not very good, right? $2 a share, $80 a share is the price, $2 in dividends. Not good at all. So are we investing in Starbucks for dividends though? No, we're not. We're investing in Starbucks because it is the premier coffee brand that is everyone's go-to, right? You don't go, there's a lot more favorites when it comes to Starbucks rather than Dunkin', right? That's what you're betting on. But from the bottom to the top, we could see 48 to 125, up 157%, 158. Now we have seen a contraction of 33%, so down a third, and we're buying it right there, that low 80s mark. You see it close today, $83. So is it cheap? Yes. Will it stay cheap? Maybe for a little bit, right? We could spend a couple days buying up and hopefully get the lowest price we could, and then wait for that rebound. This could be a definite long-term hold. We don't have to sell at 120 once it hits it, but that's a 50% gain, 80 to 120, right? So that's Starbucks. We talked about Home Depot, Starbucks. Lastly is Disney. Disney's also trading at a discount. A lot of weird stuff coming out of Disney in terms of news lately. I'm not going to mention it here. You could just look that up. But when it comes to their subscriber thing, that's a whole new introduced business that's competitive to Hulu and most importantly Netflix and Amazon Prime. just in the last couple years, right? And that's a big deal. Um, we also have to remember that Disney owns Marvel, right? And every single Marvel movie character comes out, Disney is making money off them as well. So with all this COVID stuff, dying down, the parks will finally get open. That was the hardest part about buying Disney, um, back in March of last year. I'm sorry, 2 years ago, was they're making very little money, right? Their parks are closed, no admission, like Six Flags or SeaWorld, right? Those places don't have an online version. Disney, fortunately, does. They have products, they have now media to consume. Um, so from that price, we're only seeing a increase of 67% since the depth of COVID. Um, and considering when all Disney parks were shut down for an indefinite amount of time, that's a pretty uh, not as dramatic rebound as you'd expect. So Disney's another one to watch out for. Also, was once a dividend payer. Um, we go back and see when they did pay a dividend, and they did cut that during COVID. Have yet to reintroduce it. Starbucks, on the other hand, never cut it, but they did cut their buyback program. So that's another reason. Same with their CEO coming back. It's a whole deal. All these stocks have their own deal. Home Depot probably being the less. That's more of a macro movement. All these are more, company wide, not necessarily economy. So we got Home Depot, Starbucks, and Disney, three stocks to start watching because they should be on your watch list already. They're large companies at a discount. Um, Not too often could you get blue chip stocks, at 2/3 of the price, right? 2/3 of the normal price. So hopefully you can make some money off this. A couple weeks, couple months, couple years. I'm sure you'll be in the green, no doubt. But take this with a grain of salt, right? I'm not your financial advisor. Do your own research. But that's the video, guys. Thank you for watching, and until next time.